The Bank of England will very likely have to start raising interest rates from late this year. They recently released their quarterly inflation report and revised their forecasts for growth downward over the near-term future. Central bank argues that inflation is well contained, although in the short term very high because of one-off effects related to developments last year. Over the medium term, there's a huge amount of productive capacity that's been taken out of the economy. This is unemployment rising, factories going offline, etc. That can allow us to grow without generating a lot of inflation in the next 2 to 3 years. Long story to say that interest rates don't have to go up aggressively, quickly, but they will need to start rebuilding a margin because further out, 3 to 5 years horizon, inflation will start to pick up more rapidly. So if interest rates start rising from their current very low level later this year, their long-term average is something like 4.75%, 4.5%. They're probably not approaching that level until late in 2011. That said, interest rates are going to have to rise to counter inflation, and the government is going to have to borrow more over the next 3 to 5 years because of the fiscal spending, bank bailouts, and so forth that occurred over the last 2 years. That's going to push up long-term borrowing rates as the government seeks to fund its debt burden. So higher interest rates from the central bank, higher interest rates from the government means higher borrowing costs across the economy, also pushes up the risk-free rate and raises question marks around property yields. If property yields have to compete with government debt, will it have an upward influence on yields in the medium-term horizon? I think it's a fair question to ask. I think given the rapid rise in capital values in particularly the best quality stock in the UK over the last 6 months, there is a risk around those lowest yields, given that we expect the risk-free rate and funding rates to rise in the next 18 months.